today we are going to learn a new accounting standard, that is Accounting Standard 26. It deals with intangible asset. First of all, we look on the definition of intangible asset. An intangible asset is an identifiable, non-monetary asset without physical substance held for use in production of goods, supply of service, rendered to others or administrative purpose. So, what is an intangible asset? It is an identifiable, non-monetary asset without physical substance held for use. In this definition itself, we can see some of the characteristics and some of the uses of intangible asset. First of all, we will move on to the characteristics of intangible asset. The first characteristic that is mentioned in this AS-26. What is an intangible asset? The first characteristic is identifiable. We will look on this with the help of an example. So the example here we took is patent. If imagine my organization or my enterprise is having a patent and I am planning to sell my patent to another enterprise, all the economic benefits, all the future economic benefits that I get from this patent will be lost, and that will not affect my business enterprise. So we discussed about what is identifiable. Now we are moving on to non-monetary asset. So first of all, what is non-monetary asset? To know about non-monetary asset, first of all we have to know what is monetary asset. So monetary asset means an asset that can be defined in terms of money. So non-monetary assets are assets that are other than monetary assets. The next characteristics that we are going to deal with this without physical substance. We can go through this with a help of an example. So, in case of copyright, there are legal documents that support the existence of copyright, but there is no a physical substance that shows copyright. Now we are moving on to the uses of intangible asset. In the definition itself, we deal with the characteristics and uses of intangible asset. So far we have discussed about the characteristics of intangible asset, and now first uses production of goods. So the next use is supply of services. If an enterprise is developing a software that helps in the improvement of their services, then we can say that we use that intangible asset for the betterment or for the supply of the services of that enterprise. So this can be said as a use under intangible asset. Next use of intangible asset that is mentioned in the definition is rendered service. And enterprise can use its intangible asset for rendered purpose to other enterprise, for improving, for providing services to them. The last use mentioned in the definition is administrative purpose. So, an intangible asset can be used in administrative purposes. The software that we use, like Tally, and some examples for this usage. Now we are moving on to the recognition of intangible asset. When should an intangible asset be recorded or should be recognized in the books of accounts? It is classified into two categories, that is purchased intangible asset and the next one is self-generated or internally generated goodwill. There are two recognition criteria for recognizing an intangible asset. First one is that an intangible asset should be recognized if it is probable that the future economic benefit that is attributable to the asset will flow to the enterprise. The next recognition criteria is that the cost of intangible asset can be measured reliably. Now we can look on the recognition criteria of purchased intangible assets. So to calculate the cost of purchased intangible asset, first of all we have to pay the purchase price. Then we have to add on the input duties and taxes except the refundable taxes. Then add directly attributable expenditure that makes the intangible asset ready to use. Now we can move on to the recognition criteria of self-generated or internally generated goodwill. Under this case, it is divided into two. First one is research phase and then the second one is development phase. In research phase, the enterprise is researching on the intangible asset, on how to develop an intangible asset that can be used in the enterprise. In the development phase, intention to complete the development phase. It means that if we are developing an intangible asset, we should have the intention to complete it and use it in our enterprise. The next one is technical feasibility. While developing an intangible asset, we should have all the technical feasibility to complete it and to use it in our enterprise. Here, the word feasibility means the cost that we invest should be more than the benefit we get from that particular intangible asset. Now moving on to the third one, availability of adequate technical, financial and other resources. While developing an intangible asset, we should have the adequate financial resources, the technical feasibility and all other resources should be available. Then only we can develop it and we can use it in our enterprise. Next one is the ability to use or sell. An intangible asset should have the ability to be used or to be sold. Then only we can gain economic benefit from that intangible asset. The next one is the existence of market. An intangible asset should have the existence in market. That is, it should be able to demonstrate its existence of market. Or if an intangible asset it should be used internally, then only the usefulness of intangible asset can be measured. The fifth one is the sixth one is ability to measure the expenditure attributable to the intangible assets. So we have discussed the initial recognition of intangible assets. Now we are moving on to the subsequent expenditure. How subsequent expenditure of an intangible asset affect its recognition treatment. So first one we have to look at whether the expenditure spent on intangible assets is increasing the standard of performance. If it is increasing the performance of the economic, if it is increasing the future economic benefit of the enterprise, then that expenditure should be debited to the intangible asset. If in case it is not increasing the standard of performance, then it should be debited to the P&L account. Now we can go through the subsequent measurement of intangible asset. In this case, we look at whether intangible asset will be valued at the cost price or the future economic benefit, whichever is lower. So an intangible asset should be valued at carrying amount or at the future or at the present value of future economic benefit, whichever is lower. Now moving on to amortization. What we mean by amortization? Just like depreciation for tangible assets, amortization is something that decreases the value of intangible asset. So far we have discussed about the definition of an intangible asset and the characteristics and uses that are included in the definition of intangible asset. Then we go through the recognition of intangible asset. Under this heading we discussed about purchase intangible asset and self-generated intangible asset. So we discussed how to calculate the cost of intangible asset under purchase. That is by adding purchase price, import duties, and by adding directly attributable expenses. Then we go to the self-generated or internally generated goodwill. Here it is divided into two phases, that is research phase and development phase. Under research phase, the study is an investigation is conducted whether to develop an intangible asset. So there will not be any asset recognized, and the research expenses that are directly charged, the research expenses that are attributable to that are incurred during the research phase are directly charged to the P&L. By development phase, everything we have investigated or we have studied is implemented into action in development phase. So the recognized as asset, if the recognition criteria is satisfied, then the expenses incurred in development phase are charged to asset account. Recognition criteria, there are 6 criteria. Then we moved on to subsequent expenditure. How the increase in standard of performance affect the recognition treatment. If the standard of performance is increasing, then we should debit it to the to the intangible asset account. If there is no increase in standard of performance of an intangible asset, then we should debit it to the P&L account. Then we will look about what is amortization. So this is what we have discussed in AS-26. Thank you.
Hi all, today we are dealing with Accounting Standard 2 Valuation of Inventories. Now we can look at the definition of inventories. First of all, let us see goods held for sale. So what is something held for sale? And what is that? That is of course final goods. Okay, final goods are always held for sale. The next one is goods held in the process of production of sales. Something that is held in the process of production of sales. What is that? That is of course work in progress or WIP. So first one is inventory includes goods held for sale, that is final products, and second one is goods held in the process of production of for sale, that is work in progress. The next one is materials and supplies used in the production of goods and rendering of services. So for the production of goods and rendering of services, we use some kind of materials or services, that is raw materials. So this means raw materials. The next one is consumables and spares other than those covered in AS-10, consumed in production of goods and rendering of services. So what is AS-10? AS-10 means PPE, that is plant, property and equipment. So consumables and spares are not covered under AS-10 includes here. And the next one is packages and byproducts, that is the byproducts that are arised while producing the final products. So the example of inventory is cricket. Here what is raw material? Raw material is wood. Okay, we can write that wood. And the final product is of course so we can term this as what inventories. So once again we can look what is the inventory. An inventory includes goods, something that is goods held for sale, that is final goods, and goods held in the process of production of sales, that is work in progress, and materials and supplies that are used in the production of goods and rendering of services, that is raw materials. The next one is consumables and spares, and the last one is packages and byproducts. So next portion is valuation of inventory. This is one of the major important portions of our accounting standard. So how can we value inventories? So the first one is cost or NRV, whichever is low. So what is NRV? NRV is net realizable value or saleable value. So we are valuing that as cost of inventory whichever is lower. It is one of the important part. Okay, whichever is low. The next one is valuation is done inventory wise. Yes, inventory wise, not for a group of inventories unless it is for the same class. Okay? For each inventory, valuation is done unless it is there in the same class. For example, we can say cricket method. These both inventories are different. So the valuation of inventory is also different. So the next one is measurement of cost. So in order to measure the cost of inventory, as we already know the definition, it is divided as raw materials, work in progress and finished goods. So for each item, we should analyze the cost separately. So first of all, we will look at the cost of raw materials. So now we are going to look at the cost of raw materials. First of all, the cost excludes recoverable taxes, that is recoverable taxes, rebates and trade discount. So what are recoverable taxes? Tax which can be recovered. Some kind of taxes which can be recovered is known as recoverable taxes. The next one is rebates. That is the discount given to a customer after purchasing some of our products. The next one is trade discount. It is the reduction in price of a product or service offered by the seller to the buyer. That is a reduction in the price. Okay, that is some kind of discount. So the next one is cost incidental to bring the inventories to its present condition and location. That is the costs which are incurred in bringing an inventory to its present condition or present location. We can do it in an example. We can say, if I am bringing a what we can say about 4 loads of wood at 100 per load to a factory. So wood. To a factory. We are bringing it to a by the help of a truck. So total cost is what? The total cost is 400. But we get a discount. Suppose we get a discount of rupees 20. We get rupees 20 as trade discount. So the total cost that will be incurred is what? The total cost that will be incurred is 380 rupees. 380 rupees. Rupees 380, that is 400 minus 20. And this cost, that is the next one is that the cost incidental to bring the inventory to the present condition. So we are making the wood to a truck. We get whatever charges like fire insurance charges will be there, and also loading charges will be there, unloading charges will be there. That all will be included in our cost of inventory. That's all about cost of inventory. In the case of cost of raw materials, we have already told that we exclude recoverable taxes while computing the cost of raw materials. So what about non-recoverable taxes? That is, non-recoverable taxes are not deductible from purchase price. That is, it will be a part of cost of inventory. So we cannot deduct the non-recoverable taxes from purchase price. So it will be a part of the cost of inventory. So the next one is about losses. As we all know, there are 2 types of losses: normal loss and abnormal loss. So the normal loss, it will be common to all. That is, it will be included in the cost of inventory. That is, the normal loss are occurs when the normal cost of business. So that is very normal, and it will be included in the cost of inventory. The next one is abnormal loss. That is, abnormal losses specific to the company, and so it will not be included in the cost of inventory. I will explain it by an example. So in the case of normal loss, if I am approaching an oil company for purchasing petrol, and I get about 1000 liters of petrol at rupees 100 liters. What? 1000 liters. 1000 liters of petrol at rupees 100. So 1000 liters of petrol at rupees 100. On the way of travel, we lost about 50 liters. So that is a normal loss. So the remaining liters is what? How much? 950 liters. So that 50 is a very normal loss. That is, by traveling the petrol, there will be some kind of losses in the oil. So consider it as a normal loss. Then effective cost will be what? Cost is equal to 100 liters, 1000 liters, 100. So the total cost will be what? 1 lakh. So we can consider as 1 lakh. Divided by what? The current quantity, that is 90. So we will get about 105.26 as cost. So we can add about 5 as profit. So the total will be 126 as savings. But in the case of abnormal loss, consider that along with there was also a 20 liter of loss. You job is taken what? Sorry, 200 liter of loss. About 200 liter of loss. You job is taken. So the remaining is what? Only about 70 liter. So the cost will be total 1 lakh divided by 7. That will be 120.3. Adding a proportion of profit as 5. Then it will be 130. So what is that? This increases this cost is high. Customer will not prefer to buy this. That's why we are not including abnormal loss in the cost. Okay. So in order to calculate abnormal loss, if we are using this method, it will increase the cost. So this method is inherently wrong. So how can we calculate abnormal loss? That's an equation given, that is total abnormal loss is equal to total cost divided by duty units into abnormal loss. So in this case, the total cost is 1 lakh. Good units in the board 950, and the abnormal loss is which are most abnormal is 2. Therefore, the total cost will be 210.5. This is how we calculate abnormal loss. The next one is calculation of cost of work in progress and finished goods. That is calculation of cost of work in progress and finished goods. So in order to calculate the cost of work in progress and finished goods, we need to add purchase cost and conversion cost. Fixed cost is the cost that always remains fixed. It will not vary according to the production. But in case of variable cost, it varies according to the production. So conversion cost include both direct cost and indirect cost. Direct cost include prime cost. What are prime costs? That is direct material, direct labor, and direct expenses. And indirect cost include various production overheads. And that's all included in the conversion cost. So in order to find the cost of work in progress or finished goods, we should add this purchase cost with conversion cost. So in the case of conversion cost, there is fixed cost and variable cost. So in order to consider fixed cost, we should consider actual production and normal capacity. If actual production is greater than normal capacity, consider actual production. And if actual production is less than or equal to normal capacity, consider normal capacity. We can do it with the case. So here are the 3 cases. In the first case, actual production is 80,000 and normal capacity is 1 lakh. And in the second case, actual production is 1 lakh and also the normal capacity is 1 lakh. And in the third case, actual production is 1,20,000 and the normal capacity is 1 lakh. So according to this, if actual production is greater than normal production, we should consider what? Actual production. And if actual production is less than or equal to normal capacity, then we should consider normal capacity. So according to this case, here the actual production is only 80,000 and the normal capacity is 1 lakh. So what should we consider here? We should consider this 1 lakh. And in the case 2, both are equal. So we should consider this 1 lakh. normal as a basis. So here 1 lakh. And the second is fixed cost is calculated by multiplying 1 lakh. That is the actual production into 5 lakh machinery rent and 1 lakh, which is the basis, that is normal. And the third is we should multiply 1 lakh 20,000 into with 5 lakh the machinery rent, and here the basis is 1 lakh 20,000, which is the actual production. Now we are going to discuss about various cost formula methods. So the first one is interchangeable production method, second one is retail price method, and third one is specific identification method. So the first one we are going to discuss is interchangeable production. In the interchangeable production method, we usually use FIFO or weighted average method, whichever is more apt to our inventory. We interchange between FIFO and weighted average method. That's why it is known as interchangeable production method. And there's a note here, we will not use LIFO method for the inventories. The next type of method is retail price method. This type is used by entities who are into retail businesses. In this method, a certain percentage of profit is deducted from all the products in order to be their cost. For example, we see in supermarkets, this kind of method is seen in supermarkets where there are same kind of products are available there. The next one is specific identification method. Now this is called specific. In this method, specific cost is identified and allocated to specific inventories. And this is when inventory is not generally interchangeable. This method is used when the inventories are not mainly interchangeable. For example, Kalyan Sales, etc. offers books and umbrellas for school students at the time of school reopenings. So this kind of books, etc. are treated as separate. The next one is NRV, that is net realizable value. That is the saleable value. That value, the value that a company expects by selling its product. For the purpose of calculation of NRV, the inventories are divided into three, that is raw materials, work in progress, and finished goods. So we can check it separately. So the first one is NRV of finished goods. That is the goods held for sale is known as what? Finished goods. So the NRV is equal to selling price minus cost of sales. That is the cost incurred for selling the finished goods is to be deducted from the selling price. Then we will get what? NRV. What are the various costs incurred in sales? That is commission, brokerages, etc. So these types of costs should be deducted from the selling price. This one is NRV of WIP, that is work in progress. So in order to find NRV, the equation is selling price minus cost of selling minus conversion cost. So what is conversion cost? Conversion cost is the cost incurred to change a work in progress to a finished goods. So in order to get the NRV, we should deduct the cost of selling and the conversion cost from what the selling cost. And the last step is NRV of raw materials. So NRV of raw materials is equal to replacement cost. So what is replacement cost? The cost incurred by the company to change the existing raw materials to a new one. That is the replacement cost. So NRV of raw materials is equal to what? Replacement cost. So here is an important case. This is an exception to the rule of accounting standard. So what is the rule of accounting standard? As we have already studied, the inventory should be valued at cost or NRV, whichever is less. So this is an exception to this. Consider the cost for processing wood to a cost is 1000 and NRV is 1200. So here is the exception. That is, with this 1200, we can recover the entire cost here 100. So in this case, we can consider this cost, even if it is more than the NRV. So this is an exemption to the AS-2. So for your understanding, the explanation of this case is that if raw material is used in the production of finished goods and from that the NRV of finished goods entire cost is recovered, in such case raw material can be valued at its cost even if NRV is less than cost. So this is the explanation by definition in an equation, that is, if NRV of finished goods is greater than cost of finished goods, then value of raw material is equal to what? Cost of raw material. And if NRV of finished goods is less than cost of finished goods, then value of raw material is equal to NRV of materials. So the next one is the case of valuation of joint products. So what are joint products? That is, if the production process, the production of raw materials results in the formation of multiple products, that is the case of joint products. So here is an example. Here the raw material is here, and this involves what? The purchase cost. And here the milk is processed, and that is what? Conversion cost. And this results in three finished goods, that is cheese, butter, and cream. So the thing is that the total cost is equal to what? This purchase cost and conversion cost. So total cost should be apportioned to joint products in the ratio of their sales value. So according to their sales value, what the total cost should be apportioned to the joint products. So in this case, the milk, 10% of milk is formed as cheese, and 50% of milk is used in the formation of butter, and 40% of milk is used in the formation of cream. So consider the total cost as 1000. So while apportioning this, 10% of 1000 is 100. This will be its cost, and 50% of 1000, that is 500, will be its cost, and the remaining 400 will be its cost. So here we say that total cost will be apportioned to joint products in the ratio of their sales value. So sales value is equal to selling price, that is in what price we are selling into what number of units of selling. The next one is valuation of byproducts. So byproducts are the secondary products arise in the production process of final goods. So in order to value the byproducts, I will explain in an example. So in this case, the processing of sugar cane to get the final product sugar. Here the raw material is what? The raw material is sugar cane, and the final good is what? Sugar, and the byproduct arises is what? Molasses. So this is an example of byproduct, that is molasses is an example of byproducts. So in order to value the byproducts, the total cost is what? Total cost is equal to purchase cost plus conversion cost. So here occur what? Purchase cost, and here is the process, there occur what? Conversion cost. Then we will get total cost. So the next step is that we should deduct what? The NRV of byproducts, that is from total cost, that is total cost minus NRV of byproduct from byproduct, and we will get what? Net cost. And this net cost is to be apportioned to the final product. So the next policies used in the valuation of inventory, including the cost formula methods, should be clearly disclosed. And also the total carrying amount of inventories and the appropriate classification of the enterprise is also to be disclosed in the statements. And so we are coming to the end of this unit, that is AS-2, and here we have discussed about the definition of inventories, valuation of inventories, and measurement of cost of inventories. For that, the inventories are divided into three, that is raw materials, work in progress, and finished goods. And then we have the NRV, that is net realizable values. For that valuation also we have divided the inventories into three, that is raw materials, work in progress, and finished goods. And also we have studied about the valuation of joint products and valuation of byproducts, and at last we came to the disclosure. And that's all. Thank you.
Hi all. So today we are going to learn about AS-28, that is impairment of asset. So impairment of asset. Impairment means permanent damage. So I will start the class with an example. Suppose you have a machine and its book value is 2 lakh. So after the selling value will be 20,000, and the impairment loss will be 1,80,000. That will be recorded in the books. That is 1,80,000. So coming to the meaning of impairment, that is loss in value of asset. So the scope of the impairment of asset, this AS applies to all AS excluding inventory, that is AS-2, construction contract, that is AS-7, and the financial asset, that is AS-13, and the last one, deferred tax asset, that is AS-22. So coming to the indicators of impairment of asset, that is divided into two types, external and internal. Coming to the external, that is market value differences. Suppose I have a machine and the book value is 2 lakh, but now its value is 50,000. That is one external factor, and the other one is legal charges. That is, for example, the ban of plastic, right? And the third one is technological changes. So coming to the internal indicator, there is only one, that is physical change. So coming to the terms, there are 4 terms. The first one is value in use, second is recoverable amount, and the third one is impairment, and also the final one, carrying amount. So coming to the value in use, so if the present value of cash flows including the residual value. Suppose I have a machine. That machine's the first year value is 10,000, and second year 10,000, third year 10,000, until the fifth year is 10,000. And its scrap value is 2,000. So all the above inflows will be should be taken and will be valued in the use of machine. So the second term is recoverable amount. So the rule applicable here is if the value in use or the net selling price, whichever is higher, you have to take. So the net selling price is inventory, its inventory and its NRV. So that is selling price minus later expenses. So coming to the third one, that is impairment loss. So I will explain this in an example, that is carrying amount. So we can write the CA, that is 1 lakh. And the recoverable amount, that is 25,000. So if you deduct this, we get the value of 75,000. That will be the impairment loss. So coming to the fourth one, that is carrying amount. We write the CA. So the equation for that is cost minus accumulated depreciation. If the price in book value is 1 lakh and the value in use is 25,000, so NSP 10,000. So the recoverable amount will be 20,000. So when we are recording it in the P&L, we have to write it as the impairment loss at the debit side, that is 75,000. So coming to the recognition of measurement of impairment loss, the first one is if the recoverable amount greater than carrying amount, suppose 1,50,000 and the carrying amount 1 lakh, you have to ignore it due to conservation. Due to conservation method, you have to ignore this if the recoverable amount is greater than carrying amount. For the second one, that is recoverable amount less than carrying amount. Suppose the recoverable amount is 25,000 and carrying value 1 lakh. This should be debited in the P&L account as it is charged in the P&L account. So coming to the next concept, that is cash generating unit. So for very big companies like mines, they do have a lot of assets. So some group of assets which ensure the generation of cash. So coming to the reversal of impairment loss, like if the value of asset is small, instead of decreasing, earlier if we have accounted that impairment for the asset, what should be the accounting treatment in order to reverse the impairment loss? So in the P&L account it should be credited. So coming to the disclosure part, the first one is amount of impairment loss, second one is amount of reversal, and the third one is amount of impairment loss adjusted against the revaluation reserve, and the final one is reversal of the above.
Good morning everyone. Today I am here to discuss about AS-16 borrowing cost. The borrowing costs that are directly attributable to acquisition, construction or production of qualifying asset should be categorized cost of that asset. Borrowing cost. Borrowing cost including cost and other costs that an entity incurred in connection with borrowing fund. The interest and other costs are connecting with the borrowing fund. We know what is the interest. Then I will say about the other cost of a borrowing cost. First one, interest and commitment charges on borrowings. Second, amortization of discount and premium on borrowings. Third one, amortization of ancillary costs related to borrowings. Fourth one, financial charges for asset occurring on finance lease. Fifth one, exchange differences. Example of an interest and commitment charges on borrowings. Suppose you borrow 1 crore from the bank, 60 lakh withdrawal, and then you will be paying interest charges. In this 40 lakh is in our bank. So we will pay the commitment charges in this amount. That is further interest and commitment charges on borrowing. That will be capitalized. Explain amortization of discount and premium on borrowings. Example. Suppose if you insure the debenture at the discount at the redeemed debentures at premium, both are the cost of the company. Those will be including in borrowing cost. But in case of the preferred shareholder, it's not included. The lessor is the owner of the asset, and the lessee will be a person we get the asset for the lender. So lessee pay to the amount to the lessor. The lessee payment including interest and principal amount. It is known as the financial charges. I will explain exchange difference. For example, we borrow 10 lakh rupees borrowing loan to the bank. So the interest rate in India is only there and provided in 12%. But you will be borrowed in interest only will be the interest rate is 5%. So this difference equal to exchange difference. I will explain what is qualifying asset. A qualifying asset is an asset that taken a substantial period of time to get ready for its intended use or sales. Example of a qualifying assets. Example of qualifying assets are power generating facility, manufacturing of plants and inventories. And then we can take the substantial period in total number. I will explain what is directly attributable. Suppose we will take 100 electricity machinery will be developing 100 lakhs. We will be paying 1% of interest. So 1 lakh we consider as a qualifying asset. Then the loan borrowing money used for the qualifying asset that will be considered as a capitalized in borrowing cost. Suppose we will be not used in borrowing cost, then not capitalized. So I will explain what is the borrowing cost. Borrowing cost is a qualifying asset that's divided into qualifying asset is a purchased or constructed, and then which sources can be used to borrow in the fund. Two ways we can borrow in fund. First one bank loan, second one is debenture. I will explain what is the capitalization of borrowing cost. The borrowing cost divided in two types. First one specific borrowing and second one is general borrowing. The specific borrowing means that actually interest cost incurring during the construction period less any interest income on the temporary investment of the borrowing cost. In this cost used in temporary investments. And then the general borrowing means actual interest cost incurred during the period of construction and weighted average expenditure multiplied by the weighted average interest rate. I will explain what is the capitalization of borrowing cost. The borrowing cost divided in two types. First one specific borrowing and second one is general borrowing. The specific borrowing means that actually interest cost incurring during the construction period less any interest income on the temporary investment of the borrowing cost. In this cost used in temporary investments. And then the general borrowing means actual interest cost incurred during the period of construction and weighted average expenditure multiplied by the weighted average interest rate. Example of specific borrowing. We take a qualifying asset 1 crore rupees in the loan interest is 11%. So it will be directly attributable to the qualifying asset. Example of general borrowings. This is the first question. Generally take the loan to various purposes. So first step we will be use the weighted average rate method. This is equation summation of interest rate into amount of borrowing. Then in this 10 is a bank loan percentage and the 2.5 is a bank loans borrowing cost, and then this 8 and this 8.5 is a debenture is 2%, and the 5.5 is the borrowing cost of the debentures. It is a total of the borrowing cost. We get this question. Under AS-16, companies must disclose their account policy of capitalization, borrowing cost, total amount calculation, interest rate
government grants, meaning government grants are assisted by government in cash out kind to an enterprise for the past and future compliance with certain conditions. Government grants are today first one is cash, second one is tank. Examples of tanks are machineries, lands, etc. Government grants excluded. Government assistance two types. Government assistance which reasonably have a value based on the second one is the transaction with the government which cannot be distinguished from the normal trade and transactions. Example like construction works of road, bridge, etc. Next, recognition of government grants. It should not be recognized until there is a reasonable assurance that the enterprise will comply with the conditions attached to the grant.
Today I will be explaining what is AS-10, property, plant and equipment. It is purely say about PPE. It is a new term of fixed asset. So we will see definition of PPE. It means tangible items which are held for use in production or supply of service, goods and services. And then rendered to others. For example, machinery, you will give machinery to render. Then administrative purposes. This example of administrative purposes are computers. In this PPE used for period of usage is 12 months. Some kind of PPE not applicable for AS-12. First one, biological asset data consumed. Second one, waste asset mining. It is not example mining. It is not applicable for AS-12. Biological assets classified into two. First one, plant and second one is animal. The animals are not applicable for AS-12. And then plants are that is also divided by two. First one bearer asset and second one agricultural asset. Then agricultural assets are not applicable for AS-12. And bearer asset is applicable for AS-12. Some kind of biological asset we will be including AS-12. First one is plant. I will explain bearer plant example. Suppose it is an apple tree. This is a growing period of apple tree is 12 months or more than 12 months. Then apple tree produces 10 apples. Apples are used for production and supply of services. So the two conditions are applied in bearer plant. So it is applicable for AS-12. We will be recognized the PPE. The PPE will be satisfied the two conditions. First one, future economic benefits flow to the entity, and second is cost can be reliably measured. Then I will explain recognition principle. We want to be recognized in PPE. They are satisfied in two conditions. First one, the PPE will be
So now we are moving on to how to calculate the cost of PPE. In an organization, the PPE can be developed through purchase, by self-constructing PPE and through exchange. So we'll be calculating the cost of each of these classifications separately. First, here PPE is classified as purchase, constructed and exchange. First of all, we'll look the cost calculation of purchase PPE. Here, to calculate the cost of purchase PPE, first we have to find out the purchase price, that is after rebate and discount. First of all, we have to take the purchase price of PPE after deducting the rebates and discount of the PPE. Then we have to add non-recoverable taxes. Example, custom duty. We have to deduct non-recoverable taxes from the purchase price. After purchase price, we have to add non-recoverable taxes. Example, custom duty to the purchase price. Then we have to add the directly attributable expenses such as installation expense, trial run expense, other expense to make the assets ready for its intended use. Here, installation expense means the cost incurred by installing a PPE to our enterprise. The trial run expense refers to the expense that incur during the process of trial running a machine to check whether it is working properly or not. The next one is other expense to make the assets ready for use. All other expense that is incurred while making an asset ready for its use will be added, will be known as directly attributable expense, and it will be added to calculate the cost of PPE. Next, the borrowing cost. The borrowing cost of the machinery or any other PPE will be added to the purchase price of to calculate the cost of PPE, and then the initial estimate of decommissioning or dismantling cost. Here, the initial estimate of decommissioning or dismantling cost refers to the cost that may incur for an enterprise while at the time of our lease period, we have to rent out, we have to leave our factory, and we have to make the factory to its original position. At that time, we may incur some cost. So, this decommissioning or dismantling cost refers to that cost that may occur in future. So, this is how the cost for purchase PPE is calculated. First of all, we have to add purchase PPE, then non-recoverable taxes, directly attributable expenses, and borrowing cost and initial estimate of decommissioning or dismantling cost. Now, moving on to the cost of self-constructed PPE. Here, we have to look on two factors, that is actual cost incurred on construction and allocated cost. So, self-constructed PPE means the property, plant and equipment that an enterprise or an organization construct by themselves. So, how to calculate the cost of such PPEs? We have to look on to the actual cost that incurred when constructing the PPE or the allocated overhead. There is a note for this, that is internal profits cannot be recognized as per AS-12. During the time of self-construction of a PPE, we may incur some internal profits. Such internal profits may not be added with the cost. That internal profits may not be recognized as per AS-10. And next is cost of PPE acquired in exchange of other assets. It should be recorded at fair value of asset given up or at fair value of asset acquired, whichever is more reliably measured. In this case, while the cost of exchange of PPE is recorded, we have to consider two costs, that is fair value of asset given up. The value, the net realizable or market value of asset that we are going to give up, or the fair value of asset that is acquired. And we have to recognize which among these two values, the value that is more reliably measured. We have to consider that value. The next one is cost of exchanged PPE. This is the third category of classification of PPE, that exchange PP is that we have to check the commercial substance. Now moving on to what is commercial substance. So here commercial substance means looking beyond the legal or technical aspect of a transaction to understand its economic benefits and risk. So first of all we have to check the commercial substance. Then if there is commercial substance, while checking the commercial substance there are two cases that may occur. That is, there can be commercial substance or there may not be commercial substance. In case if there is no commercial substance, then the cost will be carrying amount of cost given out. That is the book value of asset that is given out. But if there is commercial substance present, then also two cases will be considered. That is fair value of asset given up and fair value of asset acquired. By considering these two factors, the cost which is more reliably measured will be considered to calculate the cost of exchange PP. So, to calculate the cost of exchange PP, we have to check whether if there is commercial substance or not. If there is no commercial substance, then we have to take the carrying amount or the book value of assets given up. If there is commercial substance, then we have to consider fair value of assets given up or the fair value of assets acquired, whichever is more reliably measured. That's all about cost, how to calculate cost of PP.
The next one is component accounting. If an asset comprises of two or more significant components with different lives and usages, then each should be depreciated and recognized separately. So we can check the definition. That is, if an asset comprises two or more significant components with substantially different useful lives, usages and flow of economic benefits, then each component should be recognized and depreciated separately over its useful life. We can do it with an example. Take the case of an airplane. It has different significant components, that is engine, interiors, wings and tires. So here the engine's life is 5 years, interiors is 3 years and wings is 2 years and tires is 1 year. So these have different. So in that case, each one should be depreciated and recognized separately. So in order to recognize the life of PP according to this, there are different steps to be followed. The first step is identifying the significant component of PP. In this case, we have identified the significant components, that is engine, interiors, wings and tires. And the next step is estimate the useful life of each significant component. That is, here it is engine 5 years, interiors 3 years, wings 2 years and tires 1 year. Then the third step is, if the significant component is having different useful life, then it should be separately recognized and depreciated as per useful life. That is, it should be separately recognized separately and depreciated also to be separately depreciated as per its useful life. There is a note here that if the two significant components have the same life, so we can recognize that both components together. So the next one is subsequent expenditure on PPE. That is any further expenditure made for the improvement of a particular PPE. So in the case of this, if any subsequent expenditure is done on improvement of PPE, such subsequent expenditure should be capitalized provided it improves efficiency of the PPE, that is improves the future economic benefits. That is, if that subsequent expenditure increases the efficiency of the particular PPE or increases the future economic benefits, then we can capitalize that subsequent expenditure. And the next point is that if such expenditure does not satisfy the above recognition criteria, it should be charged to P&L. It should be, if it is not increasing the efficiency or future economic benefits, then we should charge that expenditure to P&L. So this is the case. Subsequent expenditure, if it improves the efficiency, it should be added to the cost of PPE. And if it doesn't increase the efficiency, charged to P&L.
Coming to the depreciation of PP, that is plant property equipment, depreciation is charged every year, and depreciation is also calculated systematic method, that is written down value method, straight line method, or any other method. So depreciation charged from the date on which asset is ready to use. Depreciation should be charged for components separately, and also the methods of depreciation, useful life residual should reviewed at each balance sheet date, that is AS-15. So other methods of doing depreciation are, the first one is unit of production method, and the second one is sum of the years digit method. We can call it as SYD, and also the third one double declining balance method. So coming to the next point, that is subsequent measurement of PP. Before subsequent measure, there is the initial recognition of PP. So we can say PPA can be subsequently measured under any of the two methods. The two methods are, the first one, that is cost method. Second one, that is revaluation model. So in the first method, the carrying amount, that is cost minus annual depreciation. In the revaluation model is an option given to a PPA based on management decision. So revaluation method should be selected when there is a material difference between the carrying amount and the fair value and the balance sheet. Evaluation method should be followed for an entire class of PP. The entity has taken its decision to revalue its building, it should revalue all the buildings of the entity. So, evaluation of selective asset within a class. For example, land and building, plant and machinery is not permitted. Entity can follow revaluation model for a particular class of assets and cost models for the remaining class of assets.
Now we are discussing about the first time revaluation. Consider under as the PP value carrying amount and material as the market value. We can see here a upward date. So the entry should come as PP amount debtor to revaluation surplus or reserve account. Next, if the 100 carrying value 100 is considered here carrying value 100 and the market value is 90. It's a downward, so it's a loss. The entry should become like P&L account debtor to PP account. Next, we are discussing about the subsequent revaluation. Revaluation happening after first time revaluation is called subsequent revaluation. There are 4 cases in the revaluation. So we are discussing the first case. RV1 is upward and RV2 is also upward. Here an example. The cost of PPE and RV1 and RV2. Cost of PPE is rupees 100 and RV1 is rupees 110 and RV2 is 120. Here RV1 entry is PPE account debtor to revaluation account, that is rupees 10. RV2 also same entry, PPE account debtor to revaluation account, same amount 10 rupees. Next, case 2, the revaluation RV1 is upward and RV2 is downward. Consider cost of PPE is 100, revaluation RV1 is 110 and RV2 is 90. Here there will come PPE account debtor to revaluation reserve surplus and revaluation reserve account debtor to PP account and P&L account debtor to PP account. Next, Case 3. Here argument is downward and the subsequent revaluation is upward. And the case 4 is the argument is downward and the RBT is also downward.